A very good morning, everybody. Welcome to the new week. I hope you've all had a good weekend. Morning, Kay.
Good morning, Ryan. Welcome back, mate. I hope you had a
Thanks, mate.
nice stay in my home country.
Yes, very hospitable, mate. Very welcoming. We were there too. The beers were cold, crystal clear and nice, and the food was awesome. So yeah, good days all round, mate.
Good
Thank you
stuff,
for
man.
hosting
Welcome
us.
back.
Yeah, definitely, mate.
Yeah, I mean,
Definitely.
I hope you didn't break anything there because I'll be there from tomorrow. So
Well,
I hope
funny
you left
enough,
the place. I hope you left the place a little bit tidy.
well, I did my bit for the environment. I kept the
Okay.
same glass on the day of the game, Thursday. We started off in a pub in the Grand Place, and I kept my glass from my first bit all the way through the whole day, even taking it into the ground and getting it filled up in the ground, all the way back to the hotel about 1 o'clock in the morning. And it's sitting,
good.
it's sitting in my cupboard now. So yeah, that was my mission. So sorry, I stole a glass from Belgium.
Don't worry.
Please don't sue me.
Don't worry. They won't notice the difference, I guess.
No, exactly. Right, let's get stuck into it. And we've got a fairly busy week of meetings and events around markets that could have a big influence coming up. I'm going to start with this week. We've got 12th to 13th of October. We've got a G20 finance ministers meeting. And there's been one of the banks, I can't remember if it's Credit Suisse or Credit Agricole, one of the credits, was out with a piece saying that apparently investors are speculating about whether this meeting is going to see the emergence of language or coordinated FX intervention talk from all these finance ministers. Obviously, it's been the hot topic, what's been happening in the dollar, so on and so forth, and we've been monitoring that over the last couple of weeks. But we're going to have a big finance ministers meeting and central bankers there as well. So any talk from that is potentially going to be big for markets. Now, just ahead of those talks, we had the ECB and PBOC announcing today that they were going to extend their Euro-1 swap arrangement. Now, this is one of the measures that some can look at to say that FX intervention is potentially growing because the use of such swap lines can aid with that sort of intervention. So the market may put two and two together on that one. We know these swap arrangements have been in place for a long while, all the way back to the GFC and the banking crisis, and they got reinvigorated again through the COVID crisis just to keep liquidity and everything ongoing. But the fact that they're extending this again potentially shows markets or central banks and governments are still worried about what's happening in markets, liquidity issues coming from all this global run up in yields and what's been happening in the dollar. So one to keep an eye on there. For China themselves, the PBOC are also deciding on their MLF rates this week, the medium financing rates. We have the LPR and the MLF, or the whatever the shorter term ones are. So they're deciding on that, currently at 2.75%. We're going to see whether they cut those again, depending on what they view the economy is happening there. Services PMI, there was the Chinese services PMI over the weekend. That dropped into contraction at 49.3 versus 55 prior. So a big drop into contraction there. Now, this all comes ahead of the weekend, the start of the National Congress meeting. I think it's the 20th National Congress. This happens every 5 years. This is the big meeting of all the Chinese leaders. It's expected where Xi's going to become president for life or leader for life. Apparently, he pushes his claim to continue in the hot seat. It's also where we're going to hear what China's going to do with the economy, what they may do with COVID policy. A whole host of things is going to come out from this thing. It starts on Saturday. We've already had some comments, bits and pieces out this morning from China. They're going to do this, that, and the other, moaning about the US So it's going to be a whole lot of bluster. But what they may do with certain parts of policy, particularly economic policy and COVID policy, could be important for markets moving forward. So expecting a lot of comments ahead of that and also over that into the weekend and next week. Looking at some of the data, just going back to Friday's NFP, and I'll let, where am I going? Over here. I'll let Kay talk a lot about the market reaction to this. But looking back over this data, another very strong report, 263K in the non-farm payrolls. I guessed in the competition 262, which makes me the champion, by the way, just so I've got boasting rights amongst the ForexAnalytix crew. But yeah, very strong numbers there. Participation rate down, unemployment rate down. So yet again, a jobs report not going the way the Fed expects to happen with rate hikes. And again, I'll reiterate, the longer that happens, the bigger the bite in the arse they're going to get when rate hikes do bite. It seems we're not seeing a huge amount of, not saying fight back, I think it's the wrong word, but reaction to rate hikes. And that's quite unusual. We're seeing it in some sectors. We're seeing some of the data going, but it's not wholesale, and we're not seeing any real tightening of conditions, which is going to be a worry for the Fed, because they would have expected to see something happen by now, the speed at which they've hiked rates. However, there was a report on Friday, the US consumer credit numbers, which was up 8.3%, leaving consumer credit outstanding at a record 4.7 trillion. Now, there's a part of this report called Revolving Credit, which includes credit cards and home equity loans. They were up 18.1% on the month on an annual basis, but for August. And this comes as a savings rate, so the amount of Americans saving now. The savings rate was 3.5%, and that's down from some 20% back in early 2021. So what we're seeing here is a big switch out of savings into higher credit, higher borrowing, particularly on credit cards. This is one area that we need to look at, because if people are using the plastic to pay for everyday goods, you know, they're getting themselves potentially dug into a hole. Now, it should be said that credit card use in the US is a lot different to how it works in the UK. Here in the UK, people use it more to top up spending on top of income. In the US, they use it more as a debit card, if you like. So people use credit cards for everyday spending, and then their money goes in at the end of the month, pays it all off, and it just carries on revolving like that. But if it starts exceeding income, that's when it becomes a problem. That's when rate hikes bite, because obviously the interest rate goes up on everything people are borrowing. Then we start to get problems. So these numbers that we got on Friday night, not very good, and something the Fed will be looking at very closely. What do you make of all the Friday data? I mean, you were here, obviously, mate, and the market moves. The Fed pivot lives another day, doesn't it?
Sorry? What did you say?
Sorry, mate?
What did you say, the last bit?
Oh, I was just saying what do you make of all the data Friday and the market reaction, the Fed pivot lives another day?
Yeah, exactly. I mean, it's like on Friday, I started with the picture of desperately seeking the pivot, and the market hasn't got it yet again. So yes, those numbers were actually around expectations, but then we see the unemployment rate went back down. I mean, for whatever reason, whether it be the participation rate or the big private non-farm payrolls as well. I'm sorry, but whatever happens, it's the unemployment rate is not going up, so we are nowhere near a Fed pivot. And then now the market will again hope for the next possibility for a pivot, which will be what is it, Wednesday or Thursday CPI. And we are going to jump from one expectation into another until now. But if we don't get it on the CPI, that I'm afraid the dollar will be in for another leg higher, I guess. To me, the report is strong, even though we had those early warnings on other indicators like the yields, for instance, coming down sharply, and some in the ISM, the manufacturing report wasn't great for the employment factor, but then we saw in the services it went the other way around. The employment index went up. So all in all, we are still not nowhere near a pivot, I'd say. And then, and I think you might have missed a lot of them. We had a lot of Fed speakers already ahead of the report, saying that regardless, whatever happens, we are not close to a pivot. And Waller was extremely vocal on that bit. But even though Brainard and the new lady Cook were saying that they were data dependent right now, they both also indicated that they were not close to a pivot. So the dollar got bought again. At first, not really hard, but then it just keeps on going right now. So I reckon as I said, we are going to go into the CPI again, probably hoping for this pivot, because the market now thinks that is the easiest thing to trade if the Fed actually would give a pivot, or the hopium for the equity markets to rebound. But if we're going to get it, I don't know. And since we are already October, the more medium-term investors will start to think about the end of year, in my opinion, because we need to wait until the 2nd of November to get the next FOMC. If the indicators don't point at a possible slowdown or a pivot, we may see a bit of dollar shenanigans into the end of year, because let's not forget that QT is also running in the background, and that tightens financial conditions without needing to hike interest rates. There's on the credit, yeah, you rightly said, America, they use the credit card in a different way than we do. But I've read one or two comments from people saying that it could also mean that they front load their expenses. And so that's why the savings rate comes down, the expenses on the credit card go up. They front load their expenses because they expect higher interest rates, and they want to get all the purchases over with. So I think there's a bit of both ends of the story to look at. But as you say, if it continues to rise in the future months, then I think there may be a bit of an accident waiting there. And then we might see all of a sudden stuff like retail sales starting to dump, and credit going the wrong way around. So we have to be monitoring those data at least.
Yeah, I mean, I'm really surprised we haven't seen greater effects from these rate hikes. You can't hike rates like they have and not see a reaction. I mean, I'll show the chart again. I've got this here. US interest rates. Give it that. So you can't have a move like that. Let's give it that thing. You can't have a move like that in interest rates and not see a reaction from it. That's why central banks hike in slow steps over a long period of time, not so quickly. So I think that if they continue hiking at this pace because they think that the economy isn't reacting to it, I think the negative reaction they're going to get grows exponentially each time, and it's going to be a real mess when it does happen. It's almost like going to be like a pressure cap. At some point it's going to blow, and then they're going to be again on the extreme and on the wrong side of it. So whereas they didn't see inflation coming and were too late to hike, they're going to over hike and then face the consequences of that. I really think that's coming, and when that happens, we better watch out, because that's going to be some volatile times going on there.
Yeah, but the issue there as well, Ryan, is that okay, we have the risk here that we are running into this kind of taper tantrum that we saw in in 2017, 18, and then all of a sudden they are forced to cut again. But I think with the difference now is that they know it's going to happen, and they actually want it in a way to happen to cool down and slow down the economy. So I think it's very it's in their part of their playbook that they are going to go over tightening, because that's what Powell told us. That was Waller or Bostich, you name it. They're all telling us that they are going to over tighten. So that's the thing. But by saying it, they started to tell us that they will over tighten when the Fed funds were only around 1.5 to 2 or something. So now we're like 1.5% higher. But they've warned the markets. They told the markets, get ready, because we are going to over tighten. So if the market is surprised by it right now, is it the central bank's fault, or is it the market's fault? I mean, just I want to. It's not only the market is always living on hopium, and they always think like, oh, the party goes on for another day, and the party for another day, and the party for another day. But the party will come to an end, and it's probably coming to an end right now. If you look at the equity markets, have finally started to react. We hovered around this S&P 500 for a long time, thinking that we would go back to 4,200, 4,300 before going down, the hopium for the party, but it's not. We are at 3,600. So I think the market is realizing that they are now serious about the over tightening, but yet, in a way, I'm not sure if the dollar already knows. I know the dollar is higher, and I know, but there's problems on the other side of the currencies as well.
Yeah.
But I'm starting to think that if they are ready to go too far, we may have a bit of a surprise into the end of the year. And for people looking for a reversal in the dollar, it might break them up really sour, unless CPI data start to come off.
Yeah, no, I agree with that. But I think the soft landing that they wanted with this over tightening, I think, is diminishing month to month, and it's going to turn into more of a crash landing. And then the longer it goes on, the harder that crash landing is going to be.
I agree, and it's probably going to start in countries who are running a massive, who actually upped massively their dollar debt. And it's going to start to bite there, and then probably the spillover into the US will come at the end of it. I agree, it's going to turn, but I'm just not one of those who are starting to look for the pivot just yet, and I fear a little bit that there's indeed, as Powell was saying, that there is more pain to take. Yeah,
no, I agree. Yeah, I am one who's starting to trade not a pivot, but the crash landing, let's put it that way. And like you say, we'll see what happens with CPI, which is coming up. Right, and to get back to that, just a quick look at the data that we do have coming up this week. Fairly quiet tomorrow. We've got UK jobs tomorrow. This week we see a round of industrial production numbers across the board there, Italy, Europe, UK. Then we get some PPI data on Wednesday from the Fed, so this will all play into the inflation numbers. But as Kay says, Thursday CPI is going to be big in the US, but not really much. I mean, usually the week after the NFP can be fairly quiet, but we do have that number, and then on Friday we get retail sales as well. So and consumer sentiment, which will be the Michigan. Is that the final, or is that where are we? September? I think that's the final reading in the Michigan on Friday, but I'll double check that. So yeah, fairly quiet on the data front, but still some key numbers to look out for there. Back to the news and other dates to put in the diary. UK Chancellor Kwarteng is going to announce his fiscal measures on the 31st of October. Now, this is basically how they're going to pay for all those tax cutting policies they announced a couple of weeks ago that sent markets into a fiery abyss of doom. Now that's happening on the 31st of October. Now there's three parts to this, okay, because this is going to be really important for the quid. We're going to have what he announces, i.e. how they're going to save or get the money to pay for all these taxes. So the market's going to react to that. Then we have the OBR, which is the Office for Budget Responsibility, and they're the ones who kicked off the mess by saying that on first look it was going to cost XYZ, and it's going to cost increased borrowing of 100 billion and here and there, and they gave it very negative news or a summary on that. So Querton's going to announce it, then likely the OBR are going to come out and either say, yep, we agree that it's not going to be a big deal, it's going to be costed well enough, it's going to be paid for well enough, and they basically give it the thumbs up. That's going to be the kicker for the pound. If they come out and say that, then we're likely to see the pound rally significantly, because that's giving them the thumbs up for the tax plans. If the OBR come out and make a big fuss again and say it's negative, it's going to be tough for him to meet those payments or those income streams to be able to pay for all this. Then we're in for round 2 of UK getting another battering. That'll mean yields probably blowing up again, the pound getting hammered. But all that then only comes a few days before the Bank of England meeting, which is the 3rd of November, which includes the MPR, the Monetary Policy Report. So we'll have a press conference and everything like that. So it's going to give the Bank of England a few days to see what the market reaction is. And I think that's going to determine what they do on hikes, whether they stick to their current path or whether they feel the market is, sensing negativity again. And then perhaps we get a larger hike than what's expected. So that's going to be big news. Don't have to wait until the end of October, but note it in your calendars now, because it's probably going to get talked about a lot in markets until we get to that point. So 31st of October, that all kicks off. Lastly, on the news front that I just picked up is obviously what's happening in Ukraine and Russia with this tit for tat attacks. We saw that bridge in Crimea got taken out supposedly by Ukraine forces, and now Russia's responding with long-range missiles into Kiev and various other cities. That could mark a renewed step up in hostilities there. We need to see how that grows. I don't think risk is really reacting to it at the moment, but it may not take much for risk to really start reacting to it. Kay, you got anything, other items you want to add to that? I know that you put a couple of bits in the newsroom yesterday, last night.
Yeah,
anything you want to mention there?
Yeah, there's this talk going on about Fed possibly now having losses because they need to pay interest on reserves, they have to pay on the reserves that are parked in the RRP, reverse repo facility, and then there's a lot of talk going on about can a central bank go bankrupt was the biggest question, and then but what happens if they make a loss? So the only thing that we need to bear in mind is that whenever the Fed had their income, they push money to the Treasury, but the thing is when they actually pay more than the money that they receive, and in between brackets make a loss, what they do, they would so they have no profits to remit to the Treasury, but what they do, they would defer, accumulate a deferred asset, and once they get back into profit, they will first of all plug the hole and then start to remit money again to the Treasury. I just wanted to say it's not something that has never happened. But it's something that the younger traders among us have never seen, and which may make them panic a little bit. And but it should not have an effect on monetary policy right here and now. Just wanted to make this precision, because if people start to panic a little bit because the Fed is paying so much money, and it's been a subject of discussion over the past weeks. I wouldn't panic over it just yet, unless the hole becomes bigger and bigger, which it should, because as they raise rates, the interest on reserves repo and IOR will also go up. So they will continue to make losses in theory in the upcoming months, but
Yeah.
nothing to hang yourself up for it, you know.
No, and obviously if they let stuff mature, they get their principal back. So there's no real profit or loss. Well, there's profit on what they've earned on those assets, but if they let them mature, then they get their principal back, and then that's just flat cash that also gets back to the treasury.
It's still only a monopoly money for now.
Yeah. So yeah, I don't think it's going to be a big. It's probably one of these things that people are going to make a big fuss of, but in reality, it's not going to be a real problem for the Fed if they, make some losses.
No. It's been the case in the past, and there's one, if you really want to make a comparison, there's one that is one central bank is really used to do a lot of these, and it's very volatile. It's for instance the Norges Bank, because there's a lot of volatility in oils and in the oil tax payments and in what the government pushes through to Norges Bank via the oil fund and back. There's a lot of money flowing in and out of the Norges Bank, but it's never affected monetary policy. So
no.
That's a good example on a smaller scale. But a more volatile scale, and just saying not to get worried about that right now.
Yeah, and it's worth reminding people, why we talk about this stuff. I mean, some of you guys and girls may be listening to this and thinking, well, what do I care about the Fed losing money or profits or losses or whatever's going on there? It's not. It's what the market thinks of it. If the market think the Fed's got a problem, it's gonna bear that out in how it trades. It may, put pressure on yields. It may put pressure on the dollar. If the commentary is that big and that negative about it, that can be enough to move markets. But if because you listen to what we say here, you do your own research, if that's actually not a big issue for the Fed, well, there's a trade for you. If you want to trade against that fear that the market's got, that's where you get your trading opportunities from. So that's why we look at these things. A lot of is what does the market think about something? Because if the market thinks wrongly, and it can be wrong on many occasions, then there's a potential for a trade. It just depends on how wrong the market goes before you can stop affording to fight against it. But that's why we look at these things and get into it, and hopefully give you a clear understanding on it. Right, so Arif wants to have a look at gilts. Anything in particular, Arif, you're looking at here? I mean, I was looking at yields today. Obviously, pretty much they're all walking the same line at the moment. The UK is no different, really. Maybe a bit higher on the back of just the volatility that we got there. But if you look at all the yields, all pretty much doing the same thing. So as far as what yields are doing and gilts, they're all walking the same road at the moment. It's all back on this pathway of higher rates are coming. Obviously, we're going to have the expectation washing machine on for the Bank of England, which is going to present higher volatility. A lot of the market still thinking the Bank of England may, be forced into higher hikes, 100 BPs, 125, 150, whatever. And that's going to be reflected in what we see in yields. But overall, the bond picture, looking at what's happening Friday, it's all just following the same thing. Bond markets are closed in the US today for the holiday. Stock market is open, just if you're wondering, if you're not seeing any US bonds moving. That's why they're closed today for the Columbus Day, I think it is, in the US. Right. As you guys and girls know, I was off last week, so I'm not fully got my head into the trading. Not that much happening as far as I can see. No real range breaks. Obviously, we're seeing dollar yen looking a bit more bullish above 145. Finally got above there and holding above there, but it's not really racing anywhere. And I'll let Kay do his round robin. He can probably talk in more detail. I'll just give you my quick 10 cents thoughts about everything. Euro dollar. Again, this is all coming on the back of the dollar strength and yields up again. The Fed pivot back in the dustbin. So looking down at those lower levels, if we get a move down to the prior lows, down at those 95s, see what happens if we get down there. It's just about, are we going to be finding support back at the old levels that we saw before? Same with cable, resistance up into 115. You know, now we're looking south again. Are we going to get moved back down to 105? It's a bit of a way to go. Obviously, plenty to stand in the way. But is that of a dead cat bounce that we saw the last week or so? Kay, what do you make of it all?
Yeah, do you want me to grab the screen for a while?
Hello?
Yeah, do you hear me?
Yeah, can hear you now, mate. Didn't hear you
those
before.
first seconds are always cut off, it seems. Yeah, I can have a look at the screens for you if you want.
Yeah, with the hand
bit of
the baton
a
over.
roundup of what's been going on and what could be going on. All right, do you guys see the euro dollar?
Yep.
Okay, so yeah, but looking at this could be a bit of a, I know Ryan doesn't like that, but could be a bit of a head and shoulder perhaps developing. Anyway, so the numbers were good, and as I was saying on in the chat room, the way I'd approached it was I had several scenarios for good till good, or really outperforming, then weak and very bad. So for me, it's the good that came out, and then despite yields going higher, they actually did not really explode. We saw 7, 8. Okay, they are closed right now, but we don't know how it's going to open tomorrow. But we saw 7, 8, 10 BPs. I don't think the bond market was shocked by them, but yeah, the dollar yields went back up. It wasn't good enough to go and retest the 4% on the US 10s, and it wasn't good enough for the short end to go up to what people like Williams, for instance, are saying about the 4.5, 4.75 final target on the Fed funds rate. So yes, the dollar remained bid, but did we break new ground? No. So so there's two things that happened to in my opinion, and which I've traded is a better dollar, and I was traded it versus the two who have the most weight hanging around their neck for now, which are the euro and the sterling, with some success, and then despite what was happening on the in the equity markets. We saw the oils going up, and we saw risk actually in the FX sphere doing pretty okay. So I've traded both of those, and I'm going to just walk through the main ones that I traded. So I had this stop entry in when the numbers came out. We were about here or so somewhere. And so I managed to grab this one, and for the time being, I'm still having like very smalls in, and as long as we stay below 98.30, 35 now, I do think there's a possibility to get down to at least stuff that we saw end of September, perhaps in the low 96s. That's possible to me. Providing that we stay below this 98, 30, 35. That's all short-term stuff, right? Whatever happens on Wednesday, we could have a completely different picture. This flying through, and then getting back to test the one below if the CPI undershoots. But this is just short-term stuff, right? So if it goes back above 98, 30, 35, I'm going to leave it for what it is. But we all know that the overall downward channel is still very, very much intact. We did test on the 5th the parity, then rejected. It's still valid, although the trend line is coming lower. I'd still look at parity, and then with a confirmation level through 10035.50 somewhere. And if on Thursday, it's not Wednesday, Thursday, the CPI would really disappoint and tell the market that the dollar may have hit a top. In the meantime, yeah, since I'm going to be out, I'm going to respect a lot of those levels and just having a trading in there and see how far it runs. And if I get out on the rest, that's okay. I already managed quite a bit of it, but it does look to be, and especially with what's happening in Ukraine again, it does look to be still trading pretty heavy, this one. On the cable, ditto. I've got it for now. I thought this 110.50 was a bit of an interesting one. You also have this 110.25-ish, which rebounded. But to me, for as long as now we are below, call it 111.15. That was also a level that where we had a couple of bounces off. Yeah, so watch this 111.15 on the cable. If we start to get go back above, we may have some more room to maneuver. And the worst may be over for the sterling sentiment right here and now, because Kwarteng and the Bank of England are trying their best to have the market relax a little bit more. But as even the week goes on, because we have this G20 in Washington, where we can imagine that Kwarteng and Bailey will be grilled by other central bankers and the IMF, for instance, in Kwarteng's case. So watch out for the sterling for the rest of the week. If they get a lot of criticism over their neck, there might be another leg lower on the sterling. But in the short term, watch 111.15. We are about 30 points below. And then a couple of other things. Yeah, dollar yen. I mean, this could have been a bit of a flag, held and broke around 144.5, and we are like gradually going back up. Now, I've seen a couple of comments over the weekend starting to talk about possible submarines like the GPIF or the post office sitting on the offer in the dollar yen, bit of stealth interventions. But to me, the real, well, I mean, can't rule anything out. They did it in the past, but and I don't know, saying and I don't think those people really know either. But as far as the dollar yen goes, it's slowly creeping back up. And for me, the main reason it's not flying is that because the MOF sent a real message to the market saying that they are looking at stuff, especially on the speed side. But the market is more concentrated probably on other dollars than trying to take dollar yen higher. So in my opinion, nothing has changed. This thing is still, it's still bid. I mean, we've seen it on this test that we had the other week, last week, below 143.90 figure there. We had a quick washout, bounced, and then now we are back. We are back nearly 2 big figures higher. So we can't say that the yen is not offered. So I think it's more a case of people being cautious, and if you have dollars to buy as a speculator, you might have reduced the percentage of dollar yen in your books just because of the MOF and the Bank of Japan, and concentrate more on other dollar pairs such as cable or the antipodians. So that, I think, is the main reason why dollar yen is not shooting. I'm not sure whether there's a lot of submarines sitting on the offer right here and now. That's for the dollar yen. A couple of others that I've been keeping an eye on. The Aussie, we're in extension zones here. 63.15. We're back on it. We went below I think people had a bit of support around there, just below 63. But for me, the next one is really 62.5. We need to get back above 63, 65 to start to think about deeper retracements. But that will be, I think, more depending on the dollar and perhaps the dollar CNH now as well, because that's creeping back up rather than strength or weakness of the antipodians. An interesting one that let me first get on to some of the metals, because gold is back on the support zone, and which was broken the other day. We had like a period below there. We broke back up, went back even up above the trend line, but now we are like firmly back below the 1705 zone, and we're back to test the 80-85 support on gold. Right, I'm going to stick my neck out and say that we are going to range trade a little bit. We could go and have a test back down to the other trend line, which is around 65.70. But until CPI, I'd rather see a range. So respect the 1665, 1705. You got $40 to play in my opinion. Silver, I'm very closely watching this this triangle here as well. It's coming in at around 1949. We always said this, and it's been a traffic zone as well. This 1940-60 is relatively interesting on silver. So I think for as long as we are above 1940-50, this thing could find a little bit of support and start to range trade, in my opinion. If we get some closes below, then we might be back into the 18s, 18 and 3/4 perhaps. But for the time being, for as long as the US 10s would cap around 4%, I view this move as a bit of an opportunity to perhaps tiny add on again, and then see what happens later in the week. Isn't around 101.20 on cable level. 101.20? What are you talking about, Brian? 101. Cable has never traded down to 101, I think. Okay, so that's for the metals. On the oils, we had a really ramp higher on the oils when it became clear that OPEC Plus was going to cut the output by 2 million barrels per day, which was really a heavy cut. And then we went to retest this zone here around 93. We're a little bit below, but we're still at $92. If that would go, there is a possibility to retest the 95, 96. And depending on what the US data will say, why not go higher? We are entering the winter period, and expectations were for if the winter was a bit tough, for this to trade back up to 100. It's all possible. If we start to come back off, keep an eye on what's happening just below 90, around the 88 level. Brent, relatively the same picture. And then a couple of other things. This is really an oil play. I think the speckies were a bit short Norwegian kroner after this rally, and then trying to buy dips, and they got it a little bit around their lederhosen, I think, at the end of the last week and start of this week. Because of those higher oils, and probably because of the situation in Ukraine getting sour again, and Norway is one of the countries that will benefit from whatever Europe needs in energy over the winter. So I think a lot has to do with that. I'm going to keep an interesting eye on 1027, 1028, up to 1032 on the Euro NOK. Barring the oil, since Norges Bank is selling a lot of Norwegian kroner per every day, I'd rather let it go another percent and look at the other side. But I'm not involved right here and now. Top side, keep an eye on 42, 44 on the Euro Noki if that would start to trade higher again. The more interesting one here is dollar Norway, in my opinion, because despite the dollar getting a bit on the other currencies, this has not really confirmed higher, and is actually trading back below the trend line and back below the horizontal resistance as well, which is around 10.76, 77. So keep an eye on this 72, 77 zone on the top side. If it really keep under this trend line, why not have a retest of the 1054s? You know, and that would be another 1%, 1 and a bit percent lower. There's going to be a big, and I've already talked about that. In my opinion, there's a big support zone in the medium term, anywhere between 1040 and 1025. There's a 1.5% here, in my opinion, where there's a really big support zone on the dollar Norway. And then finally, dollar China. Our friends in China came back from their golden week off with a lot of COVID issues, and then going into the CCP conference, and that I think starts at next week on the 16th or so. It starts next
Saturday,
week. Saturday.
Saturday.
Yeah. Okay. So it starts on the 16th, and there's going to be, as usual, a reshuffle of the main body, the people going to lose their job and others going to get a new important role. I'm counting on the researchers to tell me who is hawkish, who is a bit less, but I guess we'll soon hear. And then also to see whether she gets elevated to the status of semi-god or not. But at least the dollar China, where I thought this 703, I spoke about it, 783 to 7 was a bit of a support, went briefly below on the dollar setback, but now we're firmly back above. This trend line looks a little fragile to me. I might as well take it off and just watch the fibs here. Big support. If we ever would dive back under 7, is going to be the 690, 693 area. But for the time being, I'd watch the dollar on the one hand, the fixings on the other, because let's not forget that PBOC had asked their guys to get ready for interventions, but also not to trade too far away from their fixings. The fixing was just below 710 today. Yeah, dollar China is trading up at 715 because I think the speculative community is still the same as me, not having a lot of confidence in what's happening on the CNH. So I'd look for setbacks to try and get back into this one. And really, well, the last one, dollar MEX is rangy, quite flat, around 20 the figure right now, and still benefiting, I think, from the far from my bed safe haven status, but that's expressed more via the crosses than really the dollar MEX. I have a bit of the same feeling on the Canadian dollar. So I think the euro dollar MEX really for going lower has to have to break 1975.80. Euro MEX is much more interesting. We're back on the yearly lows here, and there is every chance, in my opinion, just to continue this. There are massive interest rate differentials, and as I said, far from my bed safe haven status. Should keep this euro MEX under pressure. And I was going to have the last one. This one, we are back sub the euro Canada. We're back under the big 134. This was the start of the month drive in the euro higher and lowering Canadian dollar because the oils were trading lower, but big comeback back into the channel. And I think there's a chance to go and have a visit just here, 132.90 figure, and why not get back to 132s. monitoring 134, 40, 60. If it goes back above, then 135 can be seen again. But for now, it appears to me that it's relatively offered. And I'm going to leave it there. I've taken enough of your time, and I'm going to wish everybody an absolutely excellent week, because I'm going to be off for the rest. I'm going back to my home country, to Brussels, and clean up Ryan and his mate's mess of last week.
There's not that much. I can tell you a couple of good restaurants to go to, mate. Yeah, we didn't leave that much of a mess anyway. No more than usual. Yeah, so Kay's going to be off for the rest of the week. So safe travels to you, mate. Obviously, I'll be speaking to you for the rest of the day in the room. Are you going today, or are you off tomorrow?
I'm basically after the fixing today. I need to get ready because we have a very early departure tomorrow. Yeah,
cool, mate. Okay, well, I'll speak to you the rest of the day, and yeah, have a great trip, mate.
Thanks, everybody.
Yeah. Right. So just to finish up, just one thing I wanted to make you aware of: the ForexAnalytix platform is going up in price, and the current price that's being run at the moment, I believe this is the last day for it. So if you were having any last-minute thoughts about joining the ForexAnalytix platform, you can do so at the old price. And you can take advantage of the ForexAnalytix, the Forex Flow special 20% off discount. So this is, I believe, the last day. From this point onwards, tomorrow, the price will be $189 for the service. You can still use the Forex Flow discount for that. So let me put that in the chat room for you. But obviously, it will be on the higher rate, not the lower rate. So if you did want to lock in, you can do so today. You won't be affected by the price rise if you're on a current subscription. We don't raise prices for current subs. That they're in at the price they're in at for as long as they subscribe. So it's not like you can join now at the cheaper rate and in 2 months we'll hike the price on you. No, you will keep your rate as it is all the way through the lifetime of your subscription. So on that note, we've already wished Kay a good week away. I wish you guys and girls a good trading week. We'll obviously be back tomorrow to talk about what's next on the agenda. But have a great day. We look forward to the week ahead, and we shall see you all tomorrow. Have fun.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.